A short squeeze.
Short squeeze.
For a short squeeze.
Short squeeze.
If you consume enough financial media, eventually you will hear the term short squeeze. If you don't know what that means, this video will make it clear. A short squeeze is when the investors that are shorting an asset get squeezed out of their position, causing an escalation in price for that asset. This phenomenon often looks like a jump in price, which triggers a bunch of shorts to cover their position, which leads to a second escalation in price for that asset. When someone shorts an asset, what they are doing is borrowing that asset from a broker or from some other party. They then go on to sell that asset at the current price. The premise of their short, the premise of their trade, is that at some point in the future, the price will be substantially, meaningfully lower than the price that they sold that asset for. So when they buy it at that new lower price and return it to the entity that they borrowed it from, the effective spread, the difference between what they were able to sell it for and what they were able to buy it for, turns into their profit on the trade. Unfortunately, that strategy can't work if the price of the asset only goes up. When an asset that they've anticipated going down goes up, at some point they will have to take their loss and buy the asset at that new inflated price. If there are a lot of shorts who have all made the same trade against an asset and it goes up in price, there's a bit of a cat and mouse game where you're not only calculating, will it go down in price, but also, should I buy and cover my short now before the other shorts decide to buy and cover their short? The reason this causes an escalation is as more and more shorts cover their position, you have more and more forced buying of the asset, which just leads to higher and higher prices. Interestingly, there is no limit to the amount of short interest on a particular asset. The meme stock mania of early 2021, featuring names like AMC and GameStop, was predicated on a bunch of high-risk bets on these companies that had very large shorts against them. Because there were so many short sellers, so much short interest against these names by hedge funds like Melvin Capital, those investors that took the opposite of that trade profited handsomely from the enormous amount of forced buying that occurred when all these shorts had to cover their positions on the run-up in price. You can be sure that anytime an asset or a basket of related equities skyrocket in price at the same time, that there's some short somewhere feeling the pain associated with it.
We're going to wait, and we are going to wait, and we are going to wait until they feel the pain, until they start to bleed. That is what I want.
But what about our clients who've entrusted us with their savings?
I say when we sell.
This isn't about you. This isn't about you.
Hey,
You're up
hey,
inside mahogany.
hey, I say when we sell.
So at a micro level, this is a very common occurrence when there is volatility in the market. However, instances like the meme stock mania, featuring GameStop, AMC, and a couple other names of early 2021, is a relatively rare phenomenon that's catching headlines and happening in such a public and extreme way.